Happy Financial Friday. Today we're going to be talking about when paying off your mortgage aggressively is not a good idea. So if you're new to the channel, I'm a mortgage lender licensed in 48 states. All I do is talk to people about money all day long, look at their income, look at their assets, talk to them about their future. And this is one of those topics that comes up a lot. Because I'll have clients where they're like, hey Jen, I've got a couple extra $100. Should I be putting that towards my mortgage? So here's what I want you all to consider. Yes, paying off your mortgage is the American dream and it's the ultimate goal. So let me be very clear on that. However, there are some other puzzle pieces that you should get into place before you start aggressively paying down that mortgage. Let's talk about that. So you've got your mortgage over here, right? And I'm gonna say, look, make the basic payments, the principal and interest. Do not even consider paying extra on that mortgage until, number one, you have no debt. So credit card debt's between 19 and 30% right now. Klarna, buy now, pay later, student loans, car loans. If that stuff is not paid off, you should not even be thinking about paying down this mortgage. The interest rates on all of that is more. The debt potential on all of that is more. So number one, all debt has to be paid off except for the mortgage. Number two, what does your savings look like? A lot of times, like the average American doesn't have much savings right now. It's that simple. And a large part of it's because of stagnant wages and inflation. But if you have extra money, make sure you're building up that nest egg. And what I would say is have at least 6 months in a savings account for emergencies. So what do I mean by 6 months? If you do a budget and you see that with your mortgage payment, your health care, everything that you have, gas, food, electricity, water, your cost is about $5,000 a month, then I would say that you need to have $30,000 in a savings account that you do not touch unless there's an emergency before you even think about this. Okay, so number one, pay off debt. Number two, 6 months at a minimum. And I'll hear like, well, I don't want that money just sitting there. I've seen so many people need to refinance and take equity out of their house because they got aggressive paying off their mortgage, but they weren't having any savings. And what happens is someone could get sick, a car could break down, a house could need a major repair. And the problem with refinancing is all that hard work that you did to pay down the mortgage, you're just tagging it right back up, okay? And look, if you're in a really dire position, you may not be able to touch the house's equity. I can't stress that enough. Like, life changes. I had a client once, he was self-employed, incredibly successful. So we did a 15-year mortgage, his debt to income was really low, his assets were great, really, really strong buyer. He came back a couple years later and he said, Jen, I need to get into a 30-year. I can't make the payment. And I'm like, what's going on? His wife had gotten cancer. She got very sick. They used all of their assets trying to fight cancer. He wasn't at work. His business suffered. We couldn't refinance him because we didn't have the income that we needed in order to get him, A, more cash out, but also B, into a 30-year loan. So really mindful about emergencies happen, okay? The next thing is retirement. Are you saving for retirement? Do you have an IRA? Do you have a 401k? Do you have a game plan? If you haven't saved anything for retirement, I don't even care if you're 20, the minute you get a job, you should start saving for retirement. It's your only chance of ever retiring. So unless you also are contributing to your retirement and you have a game plan, do not get aggressive with this, okay? Getting aggressive with your mortgage is the step to take after you have no debt, savings, you have a good amount of savings, and you have your retirement growing, building, and you're actively contributing to it, okay? Now, what is another reason paying off the mortgage aggressively may not make sense for you? So let's say you have no debt, you've got savings, you're contributing to retirement. Well, it depends on what your rate is. For instance, I refinanced back in the day. Of course I did. I'm a mortgage lender, and my rate's 2.625 on a 30-year. Don't hate me. I know. Okay. Paying down that mortgage right now aggressively doesn't make sense if I can buy a CD, a certificate of deposit, that's paying me 5% or 5.5%. You know, there's other opportunities for money that may make more sense based on your goals. You know, some people are comfortable with the stock market and they may make more doing that than paying down the mortgage. It also depends on where you are in your career. Like, I'm still pretty far off from retirement. So in my case, rather than getting aggressive with the mortgage, trying to make more money off of every extra dollar I have is a better goal for me. Now, when I get within 5 to 10 years of retirement, is this going to be the priority? Yes. But, you know, hopefully over the years, I do well with my investing so that paying this down is easier. When you have one of these stupid low interest rates, you know, from that era, seriously, your money, you can make more money with your money right now than paying that down. Now, the other reason you may not want to pay down a mortgage quickly is if it's an investment property. That's something I'll see a lot, where someone's like, oh yeah, you know, the rate's 3%, but I just want to pay it off. I've got it rented out. I would talk to your tax advisor, because, you know, you're going to have to declare your rental income, and interest is something that you can write off against that. So talk to your tax advisor about that to see if it makes sense. But once again, could you be doing more with your money than paying down that really low interest rate? Now, if you're at a 9 or 10% interest rate, I get it. But at the same point, if you're renting that property, the rent should be paying that mortgage. It should be paying taxes and insurance, so that ultimately the tenant pays the house off for you without having to do any additional acceleration on your part. So look, those are some things to consider before you get aggressive with paying off your mortgage. The overall goal is to be as financially fit as possible. And a lot of times we're kind of programmed to just go, do this. But no one's talking about the other stuff, like pay off the debt, get the savings, you know, stack the retirement, then do this. Or if you have all this, is doing this the best use of your money? Or are there other ways to grow your money? So thank you for watching. Hey, feel free to drop what you're doing. What are your goals? What's your plan? You know, when are you going to get that mortgage paid off? Are you doing other stuff with your money? Drop it in the comments. Thanks.